Hey guys, it's Marcus Graber. So recently I picked up a stock, Overstock stock, and in this video we're talking about covered calls and a covered call example. And the example that I am going to show today is about Overstock. So if we look over here, this is Overstock. I recently bought this. I think I picked it up on Thursday for around $74, a little bit over $74. Now it's at $76.83. So when did I sell a covered call? And Overstock, picking it up, covered calls was a big part of why I wanted to pick up Overstock, besides the interesting prospects that Overstock has. But if we look over here, I think I sold a covered call on Friday when it was right around $78. I think $78.10. This is just to give an example. I want to show a little bit about time decay and how that has played so far with this stock and with the options contract that I have with this. So if we see this, we can see that the price action after I sold it, we went down a couple of dollars, or at least $1.50 or so, a little bit more, because we closed at $76.83. So what do we think that my contract was worth here? And then what do we think it would have expired at? Or not expired, just where would it have ended at the end of the day? So let's check that out right now. So we can look over here. This is Overstock, the call option that I sold. So this is the covered call, and basically I chose a $100 strike. This is a pretty conservative play, meaning this has to go to the stock, Overstock, needs to reach the price of $100 by Friday, upcoming Friday on the 26th. Yeah, expiration date is the 26th. Otherwise, this is going to expire worthless. So when I sold this contract, I sold it for $44. So right around here. And if we looked at the chart, right around there was, again, it was right around $78 or so. So if we look at this contract, but what is it worth now? This contract at the end of the day is worth only $24. This is interesting. Why is the contract only worth $24 when I sold it for $44? I mean, the stock price, yes, it went down. But if we look over here, again, it only went down $1.60, $1.70. It didn't go down too insanely, and yet we went down pretty significantly. What is the gain? I'm at 45%. I'm already up on this position, basically. I've gained 20 bucks already. I could close this out and gain 20 bucks. I'm going to keep it, and I plan to just hold on to this and collect the full $44 at the end of the week. Well, I already got the $44 and I can already spend the $44, but basically I have this $20 or $24 negative in my account until this expires. So one element of this, and this has to do with the time decay. This has a lot to do with just the fact that, yes, price went down a little bit, but time is the reason why we lost so much in premium. And if we look at an Excel spreadsheet here, there's nothing here, but let's just think about this. Why did it go down so much? So let's say that there's kind of 6 days. We have 5 days next week, including Friday, the day that I sold it. That could be additional days. So this one is the Friday, 2 is the Monday, and so on until we have all of these days. And 6 is the day that we're expiring on Friday. So we're looking at these days, and so if we're looking at day number one, we started at $78. This is kind of when I sold it at $78. At day number 6, for this contract to make sense at this $44 premium, this again, 44 is the premium. This is the stock price, right? This is the stock price. And so if we're looking at this, and this 44 again is the premium. Okay, so we see this here. And again, like I'm saying, well, we know this value here. This value is going to be $24, right? This is the next day, essentially. At least on day number 2, it's going to at least open at $24. We don't know where it's going to end on day number 2. But so on day number 2, this ends up being 70. It's a different price. But the main point here is that on day number 6, this should be $100 for this premium, basically for this option to be worth something. It has to be over $100. Okay, so basically in terms of the time value, what does this mean here? From going from today all the way to Friday, where does, I guess, at least the contract kind of expect price to go? So it's kind of this idea of if you have 78 to 100, we're talking about a price around 22 bucks. Divide that by 5 the remaining days, we're looking at about kind of $4, a little bit more than $4 granted, but let's just work with $4 for now. So this contract is almost expecting price to go up $4 day in and day out. So the next day, we'd expect this price to be 82 bucks. That's plus 4 bucks. Plus 4 to that, we're talking about 86 bucks. And then if we add 4 to that, we're talking about 90 bucks. And then add 4 more, 94. And again, obviously it wasn't a perfect math, so there's additional $2 here to get from 94 to 100, that's 6 bucks, but we're not going into the pennies here. The main point here is that the expectation of closing after day one was kind of 82 bucks. And so this expectation in terms of price to time is kind of not being met. And this is a big reason why the premium of $44 dropped to $24. This pretty drastic drop. The time and the price expectation and this graph that we're kind of having, and we're expecting this to be this linear graph up to 100 if this bet, basically, this call option is going to work out in favor of the person buying. So basically, it's currently saying that, okay, we're not working in favor so far because it's not hitting 82. Because in reality, right now we can see that this is not 82 here. In reality, we're talking about price that's more like we showed earlier. It was only at 76 bucks. We actually went in the other direction. I think it was 76 bucks and like 80 cents. But the main point, it wasn't 78. It wasn't even 82. Let's just put this at 77. The main idea here is that this is what time decay is doing, and this is the value of selling options. Basically, you just need time to elapse and you'll be gaining money. This stock could go up a lot. It can go up to 80, it can go up to 90, it can go up near 100 bucks, and I'll still keep all my shares. I'll make all the premium, and I won't lose my shares. Now, again, the scenario, if this actually goes over 100, that's when the option buyer is going to be profitable. And myself, I will keep my $44 in premium. And if I held on to this contract the entire time, I will lose my shares. Someone's going to buy my shares for $100 per share, paying me $10,000. So that's not such a big loss if I bought these shares for 7,400 something, because I bought these shares for $74 and something cents, right? So if I, at end of Friday, if I have to sell them at $100 a share, that won't be the biggest loss. So this is risk to reward and risk management. Clearly, if my shares just start to tank and it just starts to go down, because I bought it at 74 bucks. Let's say it goes down to $74 or $73. So that's when I'm going to start losing capital, right? So that's just like owning a stock. If the stock goes down, you'll start losing capital. But here's the benefit though. This $44 is helping me save my money on the downside. This is saying that if I go down to $73, let's say I bought it for $74. If I go down to $73.56, basically I'll be at break even because this 44 cents is going to make up the difference. So basically, in that week in and week out, not only is this just gaining me extra money, it's also protecting me a little bit from the downside. Obviously, it's not protecting me from a total market crash or an individual stock just absolutely crashing, something catastrophic happening with that company. But in general, if I'm selling these premiums day in, day out, if the stock is dropping a little bit, I should still outperform that stock's decline. And we're owning a stock because we have faith that the stock will actually be worth more at the end of the day. So we have a few things working in our favor. Clearly, we could be wrong at certain stocks, and stocks can go down, and we don't know why stocks might go down sometimes, and we could be wrong, dead wrong about a stock as well. So we have a few different things, but selling options is a good way to gain premium and also protect us a little bit from the downside, bringing our cost basis in a way down consistently, and eventually I hope that my premiums are going to pay off my entire stocks that I have eventually. We're talking about years and years and years, but eventually. Well, I hope you guys got some value from this content, and if you haven't already, smash that like button, subscribe to this channel for more content like this, and I'll catch you guys in the next one.
And keep in mind that none of this is financial advice. This is just some random guy on YouTube drawing some stick figure lines on a chart talking to you guys.